Good morning, everybody. Hopefully you had a wonderful weekend. Got some fun stuff to cover today. First thing is 5Q day breakdown from last week is this advisor trips, stumbles, and then makes a Hail Mary catch. Kudos to him. And that's a great example of when you do the 15-minute drill and you get good at things. We all make mistakes. I mean, I think many of you have heard me say that I do the 15-minute drill every day. And even so, when I'm doing tapes, and taping myself, my record is 3.5 minutes before I make a mistake. So we know we're going to make mistakes. We need to then know how to fix them. So this is a great example of how to fix them. So this is information that we covered here about 2 years ago, but I'm going to cover it again because it's great for you to know this. The 11 secrets Wall Street does not want you to know, okay? 1, I don't want you to know about any of these fees, but especially about the hidden fees. So there's many hidden fees. According to a study done by Wake Forest University and University of Florida, the 30 largest mutual funds would have to increase their published expenses by 43% if they included hidden fees caused by turnover. Is that a little or a big number, guys? And this is minimal. I'm going to actually show you, there's other studies that say it would be a heck of a lot more than this. So this is out of Forbes, 2016. How much do mutual funds really cost? So turnover. How much do they cost according to the same financial analyst journal? And you can go here to look this article up or just Google it. According to the same financial analyst journal study, which is referring to the whole article, and rather than read the whole article, I clip things out here. Cited above, the average hidden cost of mutual funds is 1.44%. That's for turnover. So their turnover cost, the hidden cost for turnover is 1.44%. Guys, is that 43%? Is that almost double or triple a lot of fund fees? Again, not an ETF index fund, but a managed fund fee. Is that just 43%, or is that a heck of a lot more than 43% just in turnover? Are you sleepy? Way more, exactly. Tax inefficiency. If the funds are held outside of a IRA, how much do the funds cost according to Morningstar? The average cost of mutual funds tax efficiency is 1.10%. So now we're up to how much? Between the average turnover and tax inefficiency, what are we up to? $2.24, right? 1.44? 1.10, so pardon me, 1.54 or 2.5%, exactly, 2.5%. Guys, what's the market average over time? What's the stock market average over time? So what have we just sucked out of the market? Just in unnecessary fees. At least 25%, depending on what number you use. If it's 10%, it's 25%. If it's 9%, it's 30%. So that's a lot to suck out. And then we haven't even talked about the sneaky cost. Now, I don't call it the sneaky cost. Forbes calls it the sneaky cost due to sneaky behavior. What are they? There are thousands of mutual funds out there competing for your hard-earned savings. So it should come as no surprise that many mutual funds engage in sneaky or questionable behavior to get new business. For example, some window dress. Prior to reporting their quarterly holdings, some mutual funds sell their poorly performing securities to hide that they own those losers. So what do, guys? Have you ever looked at a Morningstar and say, that's weird? It's saying that fund performed really well, but my clients didn't see that kind of return. What are they doing? They window dress. That's one of the things they do. The funds then buy securities whose price recently increased to make it look like they own those winners all along. See, that is BS. Cooking the books is right, Nick. Another questionable behavior is risk shifting. This is taking large gambles prior to their quarterly reporting to try to squeeze out some more returns. But these gambles do not usually pay off. A third unfortunate behavior is shirking. This is where mutual fund managers with institutional clients care more about their fund's performance than other mutual fund managers who primarily have individual investors and clients. So again, the rich get richer and the poor get what? That is, mutual funds with primarily individual investors or as clients are more likely to be lazy and shirk. Finally, so what that's saying is that a money manager has two funds. They're both named the same thing, right? So it's ABC Fund, but there's ABC Institutional and ABC Retail. So should those funds, if they're the same fund, if they're both named ABC Fund, should they perform the same? Yeah. But guess what they find out? Which one performs better? 100% of the time. Which one performs better? Well, the fees are different, but are we talking about fees here, Nick? Yeah, the institutional performs better. This isn't even talking about fees. It's talking about what? They're going to pay more attention to the institutional. Finally, another sneaky behavior is mutual funds buying old IPOs that their investment banking partners could not sell to other investors. All these questionable actions can cause mutual funds to underperform. So that's the first thing. Two, stocks don't necessarily keep you ahead of inflation. This is huge. If you asked all of your investment advisor competitors, do stocks keep you ahead of inflation? What would 100% or what percentage of them would say yes, stocks do keep you ahead of inflation? What percentage of them? 100%. And how many of them would be right? So you guys, you have information that nobody else has. What happened to stocks between 2000 and 2016? Well, Standard & Poor's in 2000 it was at 1517. 2016 is at 1940. That means it averaged 1.74% a year. Does that keep you ahead of inflation, guys? Now, what's not added to this? What's not added to this? Yeah, the fees. Well, the dividends and also the fees. So if the dividends and the fees are going to do what to each other? Yeah, they'll just cancel each other out. So that's the first thing people say, well, you didn't include the dividends. Well, we also didn't include what? How many people are having their clients invest in the S&P 500 with no fees? And how many funds, we're going to find out later, how many funds beat the S&P 500? Most or an extreme minority? So in other words, the average managed fund performed at what? 1.74% or less than that? And they charged a what? Fee. Right? NASDAQ looked even worse, 1.07. Now, stocks don't necessarily keep you in inflation during other times too. From 1965 to 1982, consumer price index went up to the point of $100 in 1965 would have cost buying the same groceries, same gas, same health care, same car, whatever. What $100 bought in 1965 would have cost $306, or 3 times as much, almost 20 years later. The S&P 500 only grew from to 137. So cost of living went up by 300%. How much did the S&P 500 go up? So that means that 30%, 37%, right? So that means it lagged inflation by how much? More than 200%, guys. This is 300% increase. This is 37% increase. What's the difference between 300% increase and 37% increase? 3 times. It lagged inflation by 3 times. By 3 times. Inflation was 2.25% greater than the market growth. So what means that? So that means that over the past 54 years, 1965 to 1982, 17 years, it lagged inflation. From 1983 to 1999, it was ahead of inflation by a lot. By a lot. 2006 to 2017, lagged inflation. The past 3 years, ahead of inflation by a lot. But how many years do we have here? We have 54 years. 34 of the past 54 years. 63, 2/3 of the time, the stock market did not keep up with inflation. How many of your competitors know that? How many of your clients know that? Is this important or not important that they know this? Your clients. We don't want our competitors to know it because we like them to be idiots. But how is it important that your clients know this? Yeah. Because what is the only reason we're told to get into stocks? So over 54 years, were stocks the right place to be over 54 years? Heck yeah. Heck yeah. Because here's the thing. During the years that it's ahead of inflation, is it a little bit ahead of inflation or is it a lot ahead of inflation? A lot ahead of inflation. The problem is, when do we figure out whether we're in this 17 years or this 17 years or this 17 years or this 3 years? When do we figure that out? When it's all over. And if you were 60 years old here, how old would you be 17 years later? If you're 60 years old here, how old would you be 17 years later? See, we don't know. So should we have all, how many people live a 54-year retirement? Nobody that I know. Or they're so rich that what? They're not working with us. So does that make sense? The one reason we're given for stocks is to stay ahead of inflation, and 2/3 of the time, that is incorrect. Now, does that mean we shouldn't have money in stocks? No. But it does mean that what? We better have a darn well-balanced portfolio, right? And more importantly, is this fact right here about the fact that stocks don't keep ahead of inflation 2/3 of the time? What is this about? What is this factoid about? Just like the 21-point checklist, what is it about? David's got it. Andre's got it. Yeah, disclosure and awareness. No one tells them, right, Dale? No one tells them that. So it's about the fact, that's right, Nick. Nobody's telling, their advisor is not telling them this. And should their advisor tell them this? Is this something that people should know or not know? Yeah, they should know this. Average rate of inflation, we know that's a big fat lie, right? We simply walk through 150, 150, add those up. What's that add up to? 100%, down 50%. 100%, 50%, add that up. 200 minus 100 is what? 100%, 25% average. Add that up, 40%, 10% average. We'd obviously want a 25% average. But we know when we put real numbers in there, we end up with what? A 0% rate of return here and 11% here. How many clients realize this? How many clients realize that an average rate of return when it's applied to real money is bogus? Heck, how many advisors know that when money's applied to an average rate of return, it's bogus? I would say probably less than 10%. Is this an important thing for people to know? Heck yeah. If you stay in the stock market for the long haul, you'll be okay. Isn't that what our competitors say to their clients? And what's the long haul? What's the definition of a long haul for most advisors telling their clients? What time period do they say is long haul? Throw one out there. Got 7 years, 10 years. Well, I hope they're not telling their clients 20 to 30 years, because so I understand you're saying that, Tom, but if an advisor told their client, now you got to hold on to these investments for 20, 30 years, or we shouldn't invest in them, how many clients are going to invest with that advisor? None. So how many advisors are really saying, now this is a 25 to 30 year time period? I mean, we may know that, but how many of our competitors are telling their clients that this is a 25, 30 year hold? How many of them are saying that to their clients? No. So what I'm asking is, what are your competitors telling their clients a long hold period is? Many of you have given me the right number already. Yeah, some people say 5, 7 to 10. Yeah. So let's use so 10. Can we say that None of our competitors are saying longer than 10 years, right? So here's the thing. If they were really sure of that 10 years was, if you hold on for 10 years, you're going to be okay, would most brokerage houses like to double their profits? Correction. Would all brokerage houses like to double their profits? Yes. So if they were really confident, if you stay in the stock market for a long haul, you're going to be okay, then here's what they should do. Presently, let's say they make 1% per year on expense charges. How many of your clients or their clients would like to make a guaranteed 6% rate of return? How many of your clients, you said, I'll give you a guaranteed 6% rate of return for the next 10 years. How many of them would sign up for that? Hell, you know how much money I put into that? Millions. Yeah. Okay, so if they're really certain, and we said that the stock market averages what over long periods of time? Between 7 and 10%, right? That's what most of our competitors say. So let's look at this then. Why don't they do this then? Why don't brokerage houses come out with a product guaranteeing the client 6% over 10 years if they know over the next 10 years the market's going to average 7% or 8%? Why don't they do that? The client's happy because with a 6% rate of return, the company is happy with a 100% increase in their profits. So why don't they offer that? Why don't they? First of all, how many brokerages are offering that? The 6% guaranteed rate of return over the next 10 years. Yeah. So why don't they offer it? Because there is holding on for 10 years a guaranteed thing. Is a client going to be okay if they hold on for 10 years? We just run through scenarios. No, they're not. We have lots of scenarios where they're not going to be okay holding on for 10 years. But yet, do our competitors still tell the clients that? Yes, they tell them every single day. The other thing I'm not going to tell you is my guy is not the best because there is no best money manager. How do I know there is no best money manager? How do I know there's no best money manager? How many money managers would there be if there was a best money manager? One. What if there is, let's say there's, obviously no one can be the best money manager. So maybe there's 5 best money managers. How many funds would there be then if there's only 5 best money managers? But how many money managers are there out there? Dozens, hundreds, or thousands of money managers? Thousands, that's right. And hedge funds, who invests in hedge funds? Stupid people or people that are pretty worldly and have lots of money, which you can't really call them stupid, right? And we all know that Buffett had a bet with all the hedge fund managers on whether the S&P 500 would beat them or not. Who won? Over 10 years, a long, quote-unquote, long period of time, 10 years, not 1 year, 10 years, who won? $100,000 invested at the end of 2008, or the beginning of 2008, would be worth $141,000 today, $207,000 in the S&P 500. And guys, was the market doing well from 2008 going for the next 10 years, 2008 to 2018? Was the market doing well? Yeah. And it didn't, look, by a little or a lot did the S&P 500 beat hedge funds? They weren't even in the race, were they? See? Now some money managers, like for example, did Peter Lynch beat the market in the 90s? Yes, because he was a genius. No, because what happened to his funds in the 2000s? Yeah, he was in the right place at the right time. He invested in retail stocks, which did very well, but in 2000 he got killed. And the analogy is the Russian roulette analogy. So we got a 6-shooter here, right? And we're going to have a contest. So I'm going to say, I'm going to pay the winner of this Russian roulette contest $10 million. So I got 1,000 people that sign up. let's say 10,000 people sign up. So they give them each a 6-shooter with 5 bullets in it, right? And they all spin the revolver, and then they go click. So how many people are we going to lose out of 10,000 with the 6-shooter? Well, you know what? Let's do 6,000 because that's an easier math. How many people are we going to lose with 6,000? We're going to lose 1,000, right? Okay, then we play again. So we're down to 5,000. It goes click. We lose a 6th of those. Do it again. Click. 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 We keep losing a 6 of people, 6 of people, 6 of people, 6 of people, 6 of people. So by the time we play this 10 times, we're down to what? Lots of players, or not very many players still alive. And we play it again until we're down to 1 person. And are we going to say, wow, that person is awesome at Russian roulette. They know exactly how to play. Is that what we're going to say about that person? What are we going to say? They were just what? Lucky. And how long is luck going to keep them from getting killed? What's going to happen to that player? They're going to eventually lose. So when we talk about mutual fund managers and we say, look, they beat the market, does that really mean that they're that skilled? No. Let's look at a few examples of this. Former internet fund stars 10 years after the bust. Garrett von Wagner Emerging Growth. If someone had told you 10 years ago that before the decade was over, Garrett von Wagner would be dethroned from his budding mutual fund empire and shareholders would see their investments shredded, your laughter would have said it all, because people thought he was the guru, the genius. He had it all. Emerging Growth lost 21% in 2000, dropped almost 60% in 2001, fell 65% in 2002 when the assets slipped below 100 million. That 45,000 you'd amassed in 2000 would have dwindled to 3,300 by the end of September. How much did you lose then? 45,000 down to 3,300. Today's emerging growth is called Cadre Absolute Return Fund. So what do they do when their funds get killed? What do, guys? What'd he do? Went from calling it the emerging growth to what? Embarcadero Absolute Return Fund. They changed the name of the fund. $10,000 invested 13 years ago would be worth $1,900 a day, worth 80% of what it was, 80% less than it was 13 years ago. Not only did it not make money, it lost money. Von Wagner hasn't been involved in emerging growth since 2008. He didn't return telephone calls seeking comment. He puts up some really great returns. When the bubble burst, he never really got it back. With hindsight, one can say that there was a lot more gut than strategy behind the fund. Kevin Landis, First Cant Technology Fund. What separated Kevin from his tech fund managers in the mid-90s was he actually worked in Silicon Valley and knew about semiconductors. Co-manager Cam had co-founded a medical device company and also knew about healthcare. Together, they crafted the First Cant Technology Fund, which came out in 1994. In 1999, though, its returns of technology fund and smaller sibling First Cant Technology Funds were up 190% and 153% respectively. You had to split $20,000 evenly between the two funds. You'd have been sitting on just $115,000 26 months later. Fast forward 10 years, that $115,000 is worth what? And it's struggled lately to even get back to where it was before. Ryan Jacob Kinetics Internet Fund, in December 1997, posted 196% gain in 1998. According to Morningstar, the fund soared 216% in 1999. Assets swelled to 1.2 billion from 22 million, so it went from 22 million up to 1.2 billion. $10,000 stake would have grown to $63,000. 10 years later, that would be worth what? That $10,000 investment would have swelled from 10,000 to 63,000 down to what? So these guys, were they geniuses? Or out of the thousands of money managers, they just happened to pick the right stocks for that particular year or two. This guy picked it for 3 years. But then when his luck collapsed, what happened? Number 6, things that Wall Street won't tell you. Bonds are no longer a safe place for your money. Interest rates have never been lower in 5,000 years, which means bonds are going to do what? Sooner rather than later. Going to go down. Past performance is no guarantee of future performance. They talk the talk, but they don't walk the walk. If they really believe this, they'd throw away their mountain charts and tables showing past performance instead of adding all the necessary verbiage in the small print. Guys, if they truly believed, and if the SEC and the FINRA truly believed that past performance was no guarantee of future performance, should that claim be made in tiny print at the bottom of a mountain chart, or should it be equally as big as the mountain chart? Or should they not allow you to show a mountain chart at all? Where should it be? Big print, small print? As big as the mountain chart? Not as big as the mountain chart. So here's the thing. Is the SEC and FINRA really trying to help the consumer? Or is it more still industry-based? And guys, what's the minimum hypothetical interest rate? What's the minimum hypothetical interest rate that FINRA allows you to run illustrations at? You guys should look this up. 10%. What's the likelihood a client's going to see 10% over the next 10 years? With valuations where they are right now, what's the likelihood a client's going to see 10% average rate of return over the next 10 years? High or low? Somebody's got to give me feedback. I don't even know if you're hearing me right now. High or low? LO or HI? I need some feedback, guys. Somebody type in HI or LO. Are you guys hearing me? Can you hear me?
I can hear you good, Mike, and I can see a bunch of answers coming in.
Oh, that's weird. Well, my messaging isn't working then. So I guess I'll quit talking to you guys or asking for answers since my messaging isn't working. So, okay, thanks, Missy.
Yep.
There is a reason I mistitled your accounts. We all know this one, right? PODOTD. The reason they don't do that is what? They want to crack at the kids and moving those accounts there. Number 9, actively managed accounts do not beat the index regularly enough to validate paying any fees. So this is SPIVA. Does everybody know what SPIVA is? They do they look at the percentage of equity funds outperforming benchmarks. So over the past 15 years, domestic funds, large cap, small cap, multi-cap, you name it, what percentage of funds over 15 years have beat the market? About 10% or less, right? 10% or less. And is it because those guys are the best or because they were lucky? We don't know, but we can certainly say a big portion of that 10% was lucky. And how do we know which 10, and are they the same? If we looked at the SPIVA from 2018 and 2017 and 2016, would it be the same funds in the 15-year time period? No, it's always different funds. So trying to pick the funds that are going to be in that 10%, so that means 90% of funds can't beat the S&P 500. What's the chance we're going to pick the funds that do beat the S&P 500? Not very high. And in fact, what does the best money manager in the world recommend for his wife, LeBron James, who he actually helps on a one-on-one basis, and actually for you and me? Where does he tell us to put all of our money? Where does he tell us to put all of our money? He's told the manager of the trust that's going to help his wife that when he dies, all of the money should go into the S&P 500. He's told LeBron James all of the money that if he wants to know the best investment, put all of your money in the S&P 500. That's what he said. And how is the S&P 500 done compared to the funds? We just saw that it beats 90% of funds out there. So why are we paying fees? This is showing an index fund. This is what goes to the client. With an average managed fund, this is what goes to the client. That goes to the manager. And then number 10, I would prefer that you don't know about the preferred list. I know you hire me to find the absolute best solution to your problems. It's just that my company only wants to look at solutions that make them the most money. So remember that Forbes article we were looking at earlier? The sneaky behavior, they said, how much did that sneaky behavior cost? According to academic studies published by finance professors at institutions such as the University of Texas at Austin, University of Virginia, University of Missouri, Georgia State University, the additional cost of mutual fund sneaky behaviors is 2.49%. And we said this does not include, this is the extra fees they pay to the mutual funds. This is the stacking that they do. This is the fringing that they do at the end. This is all the things that they do. And that does not include, though, turnover and taxes. Turnover and taxes were 2.5. This is 2.5, which means how much is somebody's, if they're in a taxable, how much are they losing every year to fees? 5%. If they're in a non-taxable IRA, they're still losing 3.5%. Is that a lot or little? That's a lot. And does Forbes have some vendetta against money managers and mutual funds? No. If you look through their magazine, guess who's advertising the magazine? 11, they can't make you happy. They can only make you sad. Money doesn't make you happy. As long as you live long enough to live comfortably, connections make you happy. Getting a 30% rate of return makes you excited. Guys, getting a 30% rate of return will make you excited, but does it make you happy? If you find out you have COVID-19 or you have a divorce or your child is suffering with depression, is a 30% going to make you happy? No, it'll make you excited. But if you lose 30%, and you're completely healthy and your kid's happy and healthy and you got a good marriage, are you going to say, well, thank God I got all those things. I'm happy that I got a negative 30%. See, that's the thing. Money can't make you happy, but it sure in the heck can make you what? Sad. See, we can't make clients happy. What makes men happy, guys? What makes men happy? Number one is sex. 4 out of 10 men say sex makes them happy. Number two, victory of their favorite sports team. So 7 out of 10 people will say one of these two things makes them happy. What makes women happy? And being with family, 7 out of 10, and losing weight, 2 out of 10. So 90% of women say one of these two things makes them happy. So what's missing from that list, guys? Making lots of money. See, we have the worst jobs in the world. We can't make our clients happy. We can make them temporarily excited, but we can't make them happy. But can we make them unhappy? Yeah, we can when we lose their money. So question, are all people who have money happy? Are all people who have money happy? No, in fact, some of them are the most unhappy people. Do all happy people have money? No, if you see some people in third world countries, some of those people are the happiest people in the world because they realize money doesn't make happiness. Connections do. So is your client's goal in retirement to enjoy family, enjoy traveling, enjoy friends, explore their faith, leave a positive mark on the earth? Is it to enjoy life, or is their goal to be as wealthy as possible? Which one of those is their goal? See, is it money that makes people happy, or is it the financial security it brings that allows them to be happy? Money can't make them happy, but it can allow them to be happy if they feel financially secure. It's not so much that the money as what the money does for us and our clients. So should your clients allow their money to run their retirement or their retirement to run? What do they really want? The highest return with the least amount of risk, or a return that gives them what they want without the risk of losing what they already have? Isn't this what they really want, all these things? Highest return with least amount of risk, a return that gives them what they want without the risk of losing what they already have. But stocks are right 80% of the time. Stocks are wrong 20% of the time. So should we risk everything on the odds? Should we double or nothing? So if I got $10, would I double or nothing? If you say, hey, we're going to flip a coin, double or nothing, and $10, would I do that? Heck yeah, I'd do that. I'm out 10, but I'll make 20. Yeah, I'd do that. But would anybody do double or nothing with their house? Would anybody do double or nothing with their IRA? And yet, what do they do all the time? And guys, this is what happened to the Japanese economy. Do you remember, those of you that are my age, so 50 50, 55, 60 plus. Do you remember in the 1970s and 80s, we were afraid Japan was going to take over the world. They were a powerhouse. But look at what's happened to their market from 1989 through 2019. What's happened to their market? What if you'd had money, you were Japanese and you had money in your stock market for that 10, 20, 30 years of retirement? Where would you be right now? Is this beyond the realm or possibility in the U.S.? Guys, this can happen. Now, if you looked at this, what kind of investment would have been a super investment during this time period? So, Jeff, what kind of investment would have been a super investment during this time period?
Indexed annuity. When you're going up, you're participating in the gains and you're not losing any money during those downturns.
So guys, even if this happened, we'd be okay with FIs. Your clients would be okay with FIs, right? But my guy's really good. We've all heard, I've gone through long-term capital management. 2 Nobel Prize winners, and what happened to long-term capital management. Same thing that happened to all those internet investors. Did great for 3 or 4 years and boom, lost 80% of the principal. Mutual funds, 90 to 99% lose to the market over time. Money managers, investing last year's best manager yields a loss of 18.2% a year over 24 years. So guys, if you'd invested, if you looked at all the money managers out there, and you chose the one that had the highest rate of return last year, guess what would likely happen to your account the next year? It'd go down, because what kind of risk were they taking to beat every other manager out there? Lots. And so the next year, if it doesn't go perfectly, it's going to go badly. But money managers are willing to take those risks because are they using their own money or the other people's money? And I love this chart. $10 invested in 1928 to 2002, 74 years. I haven't found a more up-to-date one because nobody's done this. But from 1928 to 2002, that's what, 80 years or 74 years, sorry. Buy and hold, with $10 would have grown to $10,957, almost $11,000. They missed the best 30 months. They missed just the best 30 months. They would have only grown to $154. That's how quickly, when the market goes up, it goes up quickly during just 1 and 2 month periods. If they missed the 30, was worth 30 months, though, it would have been worth $1.3 million. So what's more important, catching the best months or missing the worst months? If they'd missed the best 30 and they missed the 30 worst, they'd still be worth how much more than a buy and hold? How much more than missing the best 30 months? How much more? I mean, if they miss the best 30 months, even though they, if they miss the worst 30 months and they also miss the best 30 months, they'd still be far above missing the best 30 months. So it's missing the bad months. It's missing the bad months that makes you all the money. It's not being in for the good months. It's missing the bad months that makes you all the money. William Fleckenstein says it's not losing money that makes you rich. It's also what Warren Buffett says, right? Rule number 1, don't lose money. Rule number 2, pay attention to rule number 1. What Benjamin Graham says, he's called Teacher by Warren Buffett, Michael Price, Bill Gates. A 50-50 portfolio is what an average investor should do. And we can do that one better, because when you do a 50% market, 50% FIA, do FIAs outperform bonds in general? Yes. And how much more will FIAs outperform bonds over the next 10 years? By an awful lot. So guys, you are in the know. You guys are the knights in shining armor. You're the guys riding in on the white horse. You know things that your competitors do not know. Should your clients know these 11 secrets? Would these 11 secrets be a fantastic little webinar you could do for your clients? And how surprised would they be? Could you have them invite their friends to that webinar and go through that? Or after you go to that webinar, say, hey, would there be family members or friends that you'd like me to do that for? Because people want to know things. And do people like to know things that nobody else knows? Do they like to be on the inside? Do they like to know things that their neighbor and their friends don't know, so that they feel smarter than them? It's human nature. So guys, you are doing the right thing for your clients with a 50-50 portfolio. you are doing the right things, understanding that the things that the people are being spoon-fed are not right and are not correct. So you guys are the people that are working with you guys are lucky to have you, and they're going to refer friends to you, refer neighbors to you when you do and share this kind of information. Make sense? So is this helpful to everybody? Hopefully. Super. Well, then you guys have a fantastic rest of the week, and then we will talk to you all next Monday. Thanks, everybody.